All right, Jeff, what is the number one thing you're focused on right now? Why do you think it's the number one thing?
Well, Mark, can I have a 1A and 1B?
Okay, sure. Let's go. 1A
There's
and
really
1B.
there's two big things. Obviously, the first thing I think will come to people's mind is oil. Obviously, it's in the news every day. Plus, it's starting to impact everybody's daily lives. You're going to notice it when you go pay for gasoline at the pump. But there's something interesting going on in the oil market. And then the other thing is private credit, which we can talk about a little bit further. That's a little bit less immediate to most people's what their normal daily life is like. But there's a lot going on in the private credit space too. But if you start with oil, you look at where the oil futures curve is right now, and over the last couple of weeks, it has dramatically changed. Up until March 20th, the entire oil curve was rising, which makes sense. I mean, you've got lack of supply flowing through the Strait of Hormuz, drastic energy shortages that are showing up in Asia. So a lot of Asian importers are panic buying all over the planet. So oil prices, a lot of cash prices too. There's dislocation between future and cash. It's just the level of intensity in buying has been absolutely insane. Where you start to see that divergence, and where I don't think a lot of people have seen, not everybody watches WTI futures every day, is that ever since March 20th, the front end of the curve, so the near-term contracts, which is oil for delivery closer to today than not, have continued to soar. In fact, the price on Thursday just absolutely exploded. It was up by almost $12 a barrel just Thursday alone. Got to the front contract to be $111, $112. But at the same time, you go a little bit further down the curve to like August, September delivery, prices are falling. And they've been falling, like I said, for a couple months. You get into the early 2027 contracts, and the price of oil is under $70 per barrel. So you've got 111 at the front. It really should probably be like 130. You got 111 at the front, but then you've got 69, 68, and going lower from there. So that's the market basically saying we expect oil prices to soar in the short run, but then collapse not all that far into the summertime. And that raises a couple of different possibilities. The first one is a positive one. It's a good one. It's the one we're all hoping for, is that the Iran conflict ends and oil prices soar in the near term, and then they go right back down to where they should be, which is somewhere in the $50, if not less, range. While that would be possible, certainly don't want to rule it out. It seems like the longer this goes on, the longer it drags on, that's less and less likely of a scenario. And there's a couple of reasons for it. And the Trump administration shows it's not going to back down. And we talked about this before. I mean, Trump is in it to win it here. I think he's in for the long run. I think he's getting people prepared for it. So it's not like the market is saying that, it's a Taco Tuesday and Trump's going to pull out and chicken out and just run away because the price of oil is going up to $111 per barrel. Plus, there's more damage every day to oil infrastructure. The energy shortage gets bigger and bigger as we go along. So it's more and more likely that oil prices are going to be high and linger a little bit further into the future. So the futures price, not necessarily pricing the restoration of supply, is more and more starting to price the destruction of demand. Because what else would get oil prices to soar higher and then collapse? And it's just if demand collapses too. Well, and that's consistent with what you see from signals all around the marketplace.
Maybe, maybe not. So, I mean, the obvious answer is that if the long-term price is lower, the market, some of the smartest people in the world that study this, the market expects oil prices to be lower. But also, we could see, even if this is extended Trump era, by the way, for all the listeners, Jeff and I were together both on PBD podcast right when this broke out. So like a month ago-ish, right? And it was like, this was just starting, right? Here we are a month later. So maybe the market is pricing in this ends very quickly, or maybe what the market's pricing in is that capacity is being built around the strait right now. So we're seeing Saudi starting to offload a lot, not going through straits. We're seeing a lot of talk of pipelines being set up outside of the strait. And potentially what the market's pricing in is that a lot of this Venezuela oil can start to pick up some of the slack. A peace deal is brokered between Russia and Ukraine, and Russian oil comes back on the market. I mean, there's a lot of factors that could help offset some of the loss that could happen through the strait. I mean, could that be a factor? Or am I too optimistic, Jeff?
No, I'm not that optimistic. I don't think that's the likely scenario because when you look outside the oil curve, I mean, the oil curve itself is exactly what you're saying, Mark. All of the oil curve is telling us is that prices soar ahead in the short run and then they go down a little bit further down. And we have to figure out why that would be.
Right.
So when you start looking for clues around the rest of the financial landscape, you don't see a lot of positive signals. You look at the treasury curve or the TIPS market or interest rate swaps and the swap spreads, they're increasingly pricing negative scenarios. It's increasingly looking like the market is saying demand destruction. And the demand destruction isn't strictly because of the oil market. It's as much about risks that come from the private credit bust that's going on too. The five-year forward TIPS break-even rate has been dropping since the late part of January, which is consistent when we started to get more and more indications from the private credit system. And that's just a measure of the market's expectations for longer run inflation, which have been basically steady for years. But over the last 6 weeks or so, and it's gotten worse during the energy shock, the long run break-even rate has gone lower and lower and lower to the point that last week, a couple of days ago, the rate was down where it had been at the lows last April. There's not a lot of good scenarios in the marketplace when the market is pricing what happened last April. And that's just one. You look at interest rate swap spreads. Interest rate swap spreads, which were decompressing up until around the same time, same general time frame in January, they have been compressing, turning negative all over again. And swap spread is really just the market saying, and this is the biggest market that ever existed, the biggest, most sophisticated market saying the expectation for short-term interest rates to go lower continues to rise further and further. Why do interest rates go lower? Interest rates go lower because the Federal Reserve overreacts to weakness in the real economy. So the interest rate swap market is saying lower interest rates, which would be consistent with weaker demand. You put that together, what the futures curve in oil is saying, something that gets oil prices to go back down is leaning more toward demand destruction rather than some kind of workaround in supply.
Got it. So what you're saying, just to repeat this back to you, is that you could say, optimistically like I am, that the world finds equilibrium, finds oil from other sources. And it's likely that's happening. I mean, Venezuela is going to increase their oil. Russian oil could come on the market. We will have pipelines, but that's only if you're looking at isolation. What you're saying is if you look at all these other indicators, it's making you lean towards the other option, which is demand destruction because the economies are crashing.
The economy's not, it doesn't mean the economy is crashing. It just means it runs into more negative scenarios rather
Slowing
than just
down.
the most optimistic one. And historically speaking, that's what happens. Regardless of what happens with supply. And you're right. Saudi Arabia has been ramping up their pipelines to begin with, but the amount of oil that's been taken offline is just absolutely stunningly huge. We're talking about 20% of global supply that has just been dropped down to almost zero. That's really difficult to replace in the short run. In fact, it's impossible to replace in the short run. But it's not about oil supply.
But let's be clear about just that piece for a second, right? Because the strait has been closed. If, it's a big if, but if, boom, today, strait's open, boom, then that supply comes back online. So now there has been...
It comes back online slowly.
Well, there has been some damage, right? So maybe we're looking at 6 months or a year at least until some of the damage is repaired. So there is going to be an impairment on the supply because of damage that's happened to infrastructure. But hypothetically, if the straits open back up magically, most of that comes back online pretty quickly. So then the question is, what happens with that?
Yeah, so the point is that you've already seen demand destruction, literal direct demand destruction across much of Asia. We have shortfalls that are altering the behavior of economic participants all over the region. It's starting to filter its way into Europe. So the clock is ticking on that optimistic scenario. The longer that the strait remains closed, the more that demand destruction begins to add up. But then there's the price effect. And historically, this is why oil shocks usually end up in recession, is because the economy can't afford a sudden non-economic increase in oil prices. It's just... incomes don't go up to match the rising cost of gasoline, so you pay higher price at the gasoline pump. You got to take your spending from someplace else. And by the way, we've gotten a number of early indications across the economy here in the United States that suggest that's already taking place. S&P Global Services PMI, which came out this morning, was in contraction territory for the first time in 3 years. And services are right where you expect consumers to cut back when they're paying more for gasoline. So again, this could possibly go well. There is not, it's not like there's, this is a done deal, but the clock is ticking, number one. And number two, history is not on our side here, especially when prices do get up as high as they're getting to be. Let's talk
about that price though for a minute, right? Because prices are high. Prices have been much higher in the past. But if we adjust, right, 2022 prices were much higher. Obviously 2008 prices were much higher. But if we adjust oil prices for inflation compared to, let's say, 2008, are they really that high?
No, but the thing is, there are some prices that are already at record. You see, like jet fuel, for example, in Europe, that's trading at where oil would be if it's $200 a barrel. There's a lot that indicates that the true price of oil today should be about $150, $160 a barrel. And that it's being held low for a couple of different reasons. One, you got to give Trump administration a lot of credit, and Trump himself a lot of credit, because he is leveraging the downside of the oil price as a way to keep the upside relatively limited. Because every other day, what does he do? He comes out with this, oh, I've been talking with this guy over in Iran. Don't know who it is, but I've been talking to this guy in Iran. He keeps holding out the idea of exactly what you said, Mark, that we could get the Strait of Hormuz open tomorrow. And if you're an energy futures trader, you don't want to be long in the marketplace if Trump announces tomorrow that he's got a ceasefire, because prices are going to plunge. So, in one sense.
But even short of the ceasefire, because it looks like what's coming out of Iran, and I think part of the problem is that there's so many people talking for Iran because they've taken out most of the leadership. So we're getting all these mixed.
Who's left?
Right, we don't know who's left. So we're getting a lot of mixed messages. But it looks like one of the messages that seems very plausible is Iran is going to say, we're going to open up the straits, but the U.S. and Israel can't go through it. That's
Yeah, right.
they're talking about wanting to charge a tax, a tariff, whatever you want to call it. So it looks plausible. Either the super hopeful side is it just gets completely open, they lose control. That's the least likely. But it does seem highly likely that it opens up and the U.S. and Israel don't get boats through there. And if that were to happen, that seems like a likely scenario. So they say, oh, fine, we'll open up. U.S. and Israel can't go through it. Fine. What does the U.S. care? So that does seem like a likely scenario.
It seems like it's a plausible scenario.
Plausible.
I don't know how likely it is. I mean, we don't know. That's the problem. That's the level of uncertainty that the market is trying to wrestle with. There's as much downside uncertainty to prices as there is upside uncertainty to prices. And I think that's one reason why oil prices haven't gone as high as they have. But even looking past all that, it's how high is oil relative to the economic conditions that exist today? It's not comparing it to 2022 or 2008. It's how much can the economy actually absorb for an increased energy tax, which is what it really is.
Okay.
Whenever you see energy prices rise for non-economic reasons, it acts as a tax, first of all, on consumption, but even more so in certain circumstances as a tax on employment. So the real downside risk and the real downside case here is that businesses that are struggling, and they have been struggling over the last year, which is why we have negative payrolls, intermittently negative. We've got rising unemployment to begin with. How many of those struggling businesses that have had to cut back on hours and employees, they get a $5 per gallon gasoline, even if it's just for a month or two? How many of them end up actually breaking and then have to cut more employees' hours or even cut employees themselves? So it's really how much of an imposition the oil price is relative to what the economic situation, the background circumstances are right now. And that's where you start to get into some real troubling indications, because over the last 2 years, not just 2025, the last 2 years, you can really see this in the drop-off in employment. Employment really started to come down in the early part of 2024. Why? Because we had an oil shock. First of all, the Saudi Arabians took away supply, OPEC overall, in the summer of 2023, which raised oil prices to around $90 per barrel WTI. And then there was a second part of that shock in early 2024 when the Yemeni rebels closed off the Red Sea that kept the oil high. And already you saw the negative effects of that, which was hiring just basically fell off a cliff and never recovered. And it got to the point where we started to see more and more frequently, not mass layoffs that most people associate with recessions, but enough layoffs that it had the impact of reducing employment across the board. And that was before we even get to 2026. So if you have an economy and employment that's already in a weakened and fragile state, it may not take nearly as much of an oil price shock to push it over the edge. And that's really the danger and the downside danger.
I want to talk about the job losses because I want to dig into some stuff, and some stuff we talked about at the PBD show I want to bring back up. But let's just, before we wrap up on that, is there like a red line or like a price level that you're looking at that you think represents like the danger line, like 120 oil for more than 60 days? Or is there some sort of level, or do you have to sort of look at it more holistically?
I look at it as more of a matter of time, Mark, and that's why I think you can definitely be a little bit more optimistic. It's not about how high it goes, it's how long it stays there. Because that's really the factor that really determines whether or not an oil price rise becomes an oil shock. 1990 was a perfect example. Oil prices went from roughly $17 a barrel back in the good old days when oil was $17 a barrel, but $17 to over 40, but it took 3 months to get there. I know 3 months doesn't sound like long, but 3 months was enough to put a relatively weak economy that was struggling with the S&L crisis into a full-blown recession. It wasn't a catastrophic recession, but it was an economy that at least chugging along. That sounds very familiar to like what we have in 2025. It was chugging along, struggling, and then oil prices shoot up for 3 months. Really 4 months by the time oil got back down again. But a 3-month, 4-month oil shock was enough to push it into a recession. So if oil prices go back down sometime this month, then we're more likely than not to get out of this without the worst case scenario, or at least some of the bad scenarios. But if it goes beyond the middle part of April and extends into May, then you really get into the probabilities really rise for the negative scenarios.
So if prices stay above 100 or above 110 for 90 days or longer, we start getting in that danger zone?
I would think, even above 90.
Above 90?
90's already shown to be a trouble spot just in the past couple of years. Like I said, oil got only for around $90 per barrel, and it really had a negative impact on hiring and employment back in 24, and we haven't recovered from it. So $90 per barrel, somewhere around there, that's the target range.
And we could have, as I've seen, a lot of nations are talking about all participating in some sort of strategic reserve, helping offset the market. Again, potentially Russia, Venezuela coming on board. We'll see about that.
The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.